We're diving into a decision many growing families face. What do you do with your starter home when you're ready to move? Should you become a landlord and rent it out, potentially building income? Or should you sell it, cash in on your equity, and either invest that money or use it to make a down payment on your next home? The answer may take some reflection. It depends on your risk tolerance, goals, and ability to cover a down payment on a new home. But before we go any further with that, let's talk about IRS Rule 121. Whenever you sell your primary residence, the IRS gives you a break provided you qualify. Up to $250,000 in capital gains is excluded from taxes if you're single, and $500,000 if you're married filing jointly as of 2026. But to qualify, you must have lived in the home for at least 2 of the last 5 years. So if you convert to a rental and eventually sell later, you may still qualify, but only if you're within that window. Wait too long, and that exclusion will disappear. So let's say you bought your home for $400,000 and it's worth $650,000 today. That's a $250,000 gain, and if you qualify for the exclusion, that's $0 in capital gains tax. But if you convert it to a rental and then sell 6 years down the line, that tax outcome would look very different. This is one of the most important timing decisions in the rent versus sell conversation. And before we go further, I'm Alan Michelle, a financial planner with Michelle Wealth Management. This page is designed to help you make more informed financial decisions, so if that's something you're into, consider subscribing. So today we're going to break down the pros and cons of both renting and selling your starter home with a special focus on the tax implications you should be aware of. Now, real estate can build wealth, but your primary residence and investment property are treated very differently by the IRS and by lenders. So before you decide, let's talk about both sides of the equation. So let's start with the pros of becoming a landlord. Number one would be cash flow. If your rent covers your mortgage, taxes, and insurance, and ideally a little more, you have positive cash flow. That's monthly income hitting your bank while someone else builds equity. That equity building is also a benefit. While your tenant pays down your mortgage, you're building equity in an asset that could depreciate over time. The next benefit is diversification. Real estate can diversify your investment portfolio beyond just stocks and bonds. And remember that real estate may behave differently than public markets at times, but it also carries its own risk and concentration exposure, which we'll touch on later. Another consideration is use of leverage, aka debt. Leverage can amplify returns as well as risk, and many people locked in at historically low rates, like say 3%, may feel like they don't want to let go of that. So now let's get into some more tax implications. And remember, tax laws can change, so check with your CPA or tax advisor, and this content is for education, and I'm not making any direct recommendations here, purely presenting some facts. So once you convert your home into a rental, the IRS begins to treat it differently. You can now deduct not only mortgage interest, but property taxes, insurance premiums, repairs and maintenance, as well as depreciation. Depreciation allows you to deduct a portion of the property's value each year, even if the home is going up in value. So for a residential property, the IRS lets you depreciate the structure over 27 and a half years. On a $300,000 home, where the structure is valued at $240,000, that's nearly $8,700 per year of deductions. Those deductions can help offset some of that rental income that you're bringing in. At this point, you may be thinking, renting sounds nice. Cash flow, depreciation, leverage, why not do it? But let's hop back to the elephant in the room as far as taxes are concerned in that home sale exclusion. Here's why that matters to the point of depreciation recapture. All those depreciation deductions you took over the years, the IRS wants some of that money back whenever you sell. And a portion of those gains attributable to depreciation may be subject to recapture rules, often taxed at higher rates than just long-term capital gains tax. Now, some other tax considerations that you want to factor in are passive activity loss rules. If your rental generates a loss, you can't always deduct it against your regular income. The IRS has passive activity loss rules that limit this. So unless you're a real estate professional or your income is under $100,000, those losses are generally suspended until you sell. The next is that your rental income is generally taxable as ordinary income. While you can use deductions to offset some of this, it is worth being conscious of this, especially if you're a high earner and therefore in a high tax bracket. Now let's move on to where things can be troublesome as a landlord outside of just taxes. So there's maintenance and repair. So you're on the hook for unexpected repairs, which can eat into profits and potentially cause stress. You can hire a property management company, but this could also reduce profit margin depending on what the cost looks like. Then there's dealing with tenants, between screening tenants, dealing with late payments or property damage. Managing a rental can be time consuming. Then there's vacancy risk. So if your property sits empty, you're responsible for the mortgage and other expenses, even though it's not generating income. And remember that real estate is an illiquid asset, meaning it takes time and effort to sell a property, making it less liquid than other investments. And while you can sell a few shares of a stock, you can't pull just some equity out of your home without taking out a loan. Then there's concentration risk, which is the flip side of diversification. Many families already have a large percentage of their net worth tied up in a home, and keeping a prior home as a rental can increase concentration in a single asset class and geographic market. For households with strong liquidity and diversified assets, real estate may play a role in diversification. But for others, it can increase concentration risk, as most of your assets are tied up in housing. The next risk is going to be market risk, as markets are cyclical and rent and home values may fluctuate. Then there's financing complexity on your next home. Getting your next mortgage can be more complicated if lenders see you carrying the old mortgage. Rental income may count towards your debt to income ratio, but lenders may only credit a conservative amount to be wary of vacancy risk. So now let's talk about selling your home. Here are a few of the benefits. One would be immediate cash. Selling your starter home gives you access to equity you've built up, which can be used for a down payment on a new home or investments in covering expenses. Then there's avoidance of all the responsibilities and repairs we mentioned before. And then there's simplification of finances. Your situation generally is a little less complex when you're not holding on to that asset. While the cons of selling would include missed potential for future gains. If property values continue to rise, you'll miss out on future appreciation and potential rental income. And then there's transaction costs. So selling a property involves real estate commissions, closing costs, and other potential fees. That's something to be wary of as well. So here are a few other factors worth thinking about. Your local real estate market. Is it a seller's market or a buyer's market? Is rental demand high? Your long-term goals. Are you looking for steady income or long-term growth? Do you plan to own multiple rental properties? Then there's your time commitment. Do you have the time and desire to manage a rental property? And finally, run the numbers. It may be worth taking a look with a professional to sit down and run through each scenario to see the long-term impact each decision would have on your overall financial goals and lifestyle. The decision to rent or sell your starter home is a very personal one with no single right answer. The best course of action depends on your unique financial situation, your goals, willingness to take on the challenge of becoming a landlord, and before you convert your home into a rental or list it for sale, it's worth running both of these scenarios side by side. Consult with a qualified financial advisor and tax professional before making that important decision. They can help you model different scenarios, analyze the tax implications, and develop a personalized plan that's right for you. At Michelle Wealth Management, we're here to help you navigate these complex financial decisions like this one. And if you're wondering what to do with your starter home, feel free to reach out to us. Thank you for watching, and be sure to subscribe if you found this helpful.